So the next standard that we are taking is, anyway, you liked SBPR, prorated SBPR so much now. So we'll take up the topic fully. So the next topic we are revising is IND AS 102, share-based payment. So what is share-based payment? Share-based payments, people, is simply a contract between one party called entity, another party that it's a contract between two parties. Okay, one party is the entity, another is a third party. That third party could be an employee also, whereby the third party has a right to receive what? Shares. The third party has a right to receive shares or cash based on the share price. This basically, the share-based payment is simply a contract between two parties. One party is the entity, another party is some third party. This third party could be an employee also, whereby third party has a right to receive shares of the entity, or he will receive some, or they have a right to receive some cash based on the share price, provided certain conditions are satisfied, which we call it as vesting condition. Okay, that's all is a share-based payment. So if I have to drill it further, means share-based payment is simply a transaction whereby you're giving some shares or you're giving some cash, but based on the share price. Okay, but the entity here refers to anyone in the group entity, meaning parent company can give the shares to subsidiary ka employees, still it's a share-based payment, or subsidiary company can give the shares to holding company ka employees, still it's a share-based payment. So the entity here refers to, in this definition, anyone in the group entity, holding, subsidiary, anyone chalega, and the third party could be even an employee also. Okay, that is one. Okay, next is the grant date. Grant date means the date on which the agreement has been agreed upon. Obviously, it involves few parties, means they have to agree. So the agreement date, we call it as grant date. If these agreements, however, if they require shareholders approval, the day the agreement has been signed, and also this agreement has got approved by the shareholders, that becomes your grant date. Okay, so if they don't require any approval, means agreement date itself becomes grant date. If this agreement requires any shareholders approval, so the day you get shareholders approval and the agreements have been agreed upon, that day when both of these are satisfied, that becomes your grant date, because we do the accounting on grant date, or you need a fair value on the grant date, hence identification of grant date becomes important over here. Okay, then sir, there are three types of share-based plan broadly: equity settled plan, cash settled plan, or equity settled plan with cash alternative. Okay, equity settled plan, cash settled plan, and equity settled plan with cash alternatives. So one by one we will run through. For equity settled plan means simply the company will give equity shares, that's all. Cash settled plan means the company will give cash, but how much cash they will give based on the share price. Okay, that's one. So let's do a thing. Equity settled plan, will run through one question and quickly understand how that particular working works. Okay, so 1 second. See here, no, as and when we learn the concept, and we'll do one question also. I think that will be more appropriate. Okay, so I think maybe we'll take up this question. Ankita Holding grants 100 shares to each of its 500 employees. One employees, they're granting 100 shares, and there are 500 such employees on 1st January 20x1. The employee should remain in the vesting period during the vesting period. Okay, one of the conditions is, they say vesting period is basically the waiting period. Normally the companies will put some conditions. Work in my organization for 3 years and I will give you shares. That means employees won't get the shares immediately. They have to wait, in my example, for 3 years. A 3 years ka waiting period, we call it as vesting period. The shares will vest at the end of first year. Okay, in my example it is 3, here it is not 3. Okay, so the shares will vest. The employees will be eligible to buy the shares at the end of first year if company ka earnings increases by 12%. If company ka earnings increases by 12, we will give the shares to employees on first year itself, or we will give it in the second year if company ka earnings increase by more than 20% over 2-year period. On an average, if earnings for 2 years increases by more than 20% for 2 years, then we will give it in first year. If first year, rather, if it fails, then we will give it in the second year, provided earnings is more than 20%. If that also fails, means we will give it in the third year if average earnings is more than 22% over 3-year period, like that. So that they put, it's on a slab basis, it's getting vested. So the fair value of the shares in the grant date is 122. Okay, earnings increased by only 10%. Oh, okay, we are at the end of the year now. The earnings increased only by 10%. What is the criteria for shares to be eligible to get vested in the first year? Earnings has to increase by more than by 12%, but it increased only by 10. So can we give the shares in first year? No. 29 employees left the organization. Company expects that the shares will vest at the end of year 20x2. So first year, since the condition did not fulfill, now company is thinking condition will get fulfilled in the second year, that is 20x2. The company also expects that additional 31 employees will leave the organization in 20x2 and 440 employees will receive the shares. So basically they have done 500. In that 29 have already left, so they deducted 31 more they feel they will leave. So that's how they got 440. Okay. At the end of 20x2, companies in earnings increased only by 18%. So what was the target? Target for more than 20%. But second year earnings increased only by 18%. I mean second year also going the target failed. Therefore shares did not vest. Only 29 employees left the organization during 20x2. Company believes additional 23 will leave. and the earnings will further increase so that the performance will be achieved in 20x3. So company feels now it will get achieved in third year. In third year, what happened? Only 21 people left the organization. Assume that the company's earnings increased to desired level and the performance target has been met. In the third year, they're saying target has been met. So you need to do the accounting and along with the journal entries over here. Okay. So this is your, what are you giving? Have they told we will give cash based on share price? No, we are giving shares only. That means this is the equity settled plan or ESP. Okay. How to do the accounting? If you remember our class, I have made it a small format. This format you can work out for almost all the problems. I have not changed the format. I'll revise also with the same format. Okay. So what is this format? Is first check, sir. You do the accounting, right? We have few columns, particulars and years. When you put up the year column, first check if the shares are vesting immediately. If the shares are getting vested immediately, you need to have one more column on the grant date. Okay. In this problem, your shares getting vested on the same day? No. There is a waiting period. Shares will vest first at the end of first year. So immediately on the grant day, share is not vesting. So start your columns from year 1, year 2, year 3. Okay. That is one. So what are the columns you need to have is first is, sir, all these are expectation based accounting. How many employees the company gave the shares to? 500. You don't have to book this expenditure. These are like, obviously these shares are given at free of cost by the company, right? Excuse me. So obviously for company, it's a loss. So what IND AS 102 says is you don't have to book these expenses on for total employees. What the company, what leeway the IND AS 102 has given to the company is, company has to do an estimate. How many options or how many shares company thinks the employees will buy, or how many shares will be given to the employees. Only for that many option, if you book the expense, that is good enough. So hence the first thing you will do is, you will not take the total options, you will take the total number of options expected to vest. How many shares totally employees will buy, that you need to expect. Based on that expected number, you will go on booking the expense. It's an expectation based accounting. This, so your IND AS 19 employee benefits, all these are expectation based expense accounting. Okay, not the reality. Okay, I mean initially at the end of the year you see whatever it is and accordingly do the expense, because initially we don't know how many of them will really buy. Some of them may leave also. Science is an expectation based accounting. So first is number of options expected to vest. How many options did you give to how many employees you gave this option? 500. In that you are now at the end of this is year 1 ending. In the year 1 ending, how many employees actually left? 29 employees already left, sir. That means will they get it? No, because condition was not met in first year. So that means will they get it? No. So from this deduct 29. That's all? No. Company has to estimate in totally how many employees will leave. 29 have already left. Company feels further more employees will leave. Yes, the company feels additional 31 will leave at the end of first year. So 29 already left, 31 will leave. So in 500, 29 already left, 31 is expected to leave. That means how many employees are expected to say? 440. That's what they've given here. So if you do this, you're going to get 440. That is the number of employees. And to each employee, how many shares you gave? You gave 100 shares. So one employee, 100 shares. For 440 employees, how many shares? 4 lakh or 44,000. So at the end of first year, company feels 44,000 shares are going to get vested. That is one. Okay. And what is the fair value of each option? You have to find out for equity shares and people. For equity, there is no remeasurement. Okay. On the grant date, you check the fair value. What is the grant date ka fair value? Somewhere we saw here, no? The fair value of the equity shares in the grant date is 122. On that day, you find out the fair value. Take that. This is your expense, basically. This is your loss. The fair value of basically the loss of one share is 122 rupees. For equity shares, you always take the fair value on the grant date, because for equity, there is no remeasurement. Once you stick to a value, that's all it is. Okay. So you take the fair value per option, which is 122. That will be same throughout the year. Okay. All right. Next, we want the vesting period. How much is the vesting period now? Now, there was no vesting period really called. What did the company say? If target is met in first year, we will give it in first year. Now we are in the first year. Was the target met? No. Now at the end of first year, what will the company think? Okay, first year target failed. Maybe second year target will be achieved. That means what is the waiting period? When will the company able to issue the shares? 2 years. So it got issued in third year. No, that information you got to know later. Now we are in first year ending. Okay. In first year, was the target met? No. Now what will the company think? The target will be met probably in the second year. That means the vesting period will become 2. Okay. Total, when you say vesting period, you are talking about total vesting period. Total waiting period is 2 years. So why do we need vesting period? Is the expense, these employee benefit expenditure, just we call it as employee benefit expense. You're giving it to the employees, right? So this expenditure, we will book it over the vesting period. All this expenditure, we will book it over the vesting period. So if the vesting period is 2 years, we'll book the expense over 2 years. If the vesting period is 5 years, we'll book the expense over 5 years, like that. So the loss on one share is 122. How many shares we have? 44,000. So 44,000 into 122, if you do, you're going to get 53 lakh 68,000. That's the total expense. That 53 lakh, you have to amortize it, or you have to book it over 2 years. So that means you will, each year expense is how much? So basically 44,000 into 122 into 1/2. Because this, if you do, you're going to get total expense. This expense has to be amortized over vesting period. Here it is 2 years. So first year is already over, hence I've written 1 over here. So first year, how much is the expense? 26,84,000. Okay. This is the total expense to be recognized by the end of first year. Next, you have to check, has any expense recognized previously? We are in first year. We have not booked any expense. So expense recognized previously is 0. So current year, you totally have to account 26,84,000. That's all are working. So company is estimating the first year that the expense is 26,84. This is an estimated expense. Now do the same thing for second year. In second year, 500 employees were there. First year, 29 already left. Now we are at the end of second year. How many employees left at the end of second year? They told 29 employees left during 20x2. 20x2 is the second year. Okay. First year, 29 left. Second year, again 29 left. We are at the end of second year now. The company has to estimate how many options will get vested at the end. 29 left in first year, 29 left in second year. Any more employees are expected to leave? Yeah, company believes additional 23 employees will leave. That means you will deduct this also. 29, this is actually 29 left, actually 29 left in year 1 and 29 left in year 2. And company feels in year 3, 23 may leave. This is an expectation. Expectation could be right, it could be wrong, that's fine. Okay, so this many number of employees are expected to stay, and each employee is eligible to buy 100 shares. So the number of options expected to vest is 41,900. Fair value or loss is still the same because there's an equity shares. We don't remeasure it at end of every year. Once you find out, you only have to take grand date ka fair value and do the accounting. So 41,900 shares are expected to vest, and the loss on one share is 122. Okay, so if you multiply, you're going to get total loss. Now, so you are in second year. Was the target of second year met? No. Company thought in first year target may be met. Now we are at the end of second year. Was the target met? No. Now what will the company think? Target will be achieved in third year. Okay, that means what is the total vesting period in reality now? First year target was not met. Second year also target is not met. Now the company is thinking third year my target may be met. That means the total waiting period here becomes 3. So the vesting period here is 3. So this expenditure will be amortized over 3 years. So 41,900 is the number of option. Loss per option is 122. So total expense is 51. If you multiply these two, you're going to get total expense of 51,11,800. That has to be amortized over 3 years. Now we are in second year. No. So you have to multiply 2 by 3. Meaning multiply 2 by 3. Why? We are in the second year. No. So what is the total expense to be recognized? This is the total expense to be recognized. Not expense for the year. It is a total expense. You are in the second year means totally 2/3 of that expenditure should be booked. Yes, no. So into 2 by 3, that means what? 34,07,867. That much expenditure should have already got booked by the end of second year. This is not expense for current year. This is the total expense for 2 years. For 2 years put together, this is the expense. Okay. Have you recognized any expense previously? Yeah, last year you already booked 26,84,000. So reduce that. For 2 years put together, expense should be 34. You already recognized 26,84. So how much more to be recognized? These two come minus, which will be 7,23. That is the expense to be booked for the second year. Like this. Again, do the same data for third year. 500 employees, 29 employees left in first year, 29 left in second year. You are at third year end now. So how many employees left in third year? 21. So deduct that. And each employee is eligible to buy 100. So the total number of options expected to vest is 42,100. Loss per share is still 122. Now we are in third year. Was the target met? Yes. I mean, the actual vesting period is how much? 3 years. Okay. So 42,100 is the number of shares expected to vest, and the loss of one share is 122. So the total loss is 51,36,200. Okay. We are in third year now. So the entire expense has to be booked because there's a total expense. You are in the third year. So total expense to be recognized for 3 years put together is 51,36,300. So if you want, you can write 3 by 3 or ignore it. That's your choice. Okay. All right, this is the total expense. Have you booked expense previously? Yeah, you booked 26,84 in the first year, 723 in the second year. If you add these two, obviously you're going to get this much. 34,7,867 has already been accounted. So in 51, 34 lakh has already been accounted. So how much you need to account in the current year? 17 lakh. So this is the expense to be booked every year by the company. Now the journal entry. The journal entry is very simple. You're giving this to the employees, right? So the journal entry is employee benefit expenditure cost now. So employee benefit expenditure account debit. I think we can look in the journal here only here. Employee benefit expense account debit for the first year. To what? Have you already given the shares? No, you'll give the shares only in the third year. We are in the first year. So you'll write here share-based payment reserve, SBPR. Remember business combination we just now we learned that. You'll write here SBPR as in share-based payment reserve. Okay. And this employee benefit expense, you'll transfer it off to P&L. That they've not done. If you want, you can just write it in the first year. So SPL account debit to employee benefit expense. In the first year, you'll write 26,84,000. This is a transfer entry. Second year, same entry you'll pass. But what is the expense for second year we got? Second year expense for us is 7,23,867. Same entry for 7,23,867. Employee benefit expense to share-based payment reserve. And this employee benefit expenditure, you need to transfer it off to P&L. Third year, what is the expense we got? 17,28,333. That's the same entry they passed for this. Okay. At the end of third year, what happened? probably the shares, they've not given the information, but they've assumed that shares have got vested. Okay, mean shares have got, all the shares we have given to employees. Correct? Sir, right now have you all, so when the company issues shares, it is share capital for them. Right now, have you parked it in share capital or one reserve? In one reserve called SBPR. So when the shares have been issued, SBPR will be cancelled by debiting, and you will credit what? Equity share capital, because on actual date the share got issued, you will write SBPR account debit to equity share capital account. If these shares by chance are issued at premium, means you may also get security premium account. In this problem, no data is there. So hence entire amount they put it under equity share capital itself. So this is the treatment for the equity settle plan. Okay. Now let's come back and learn the next one. That is cash settle plan. Cash settle plan means the company will give cash based on the share price of the entity. In cash settle plan, cash, the shares will not be given to the employees or third party. Cash will be given, but how much cash you will give will be based on the share price. Hence, this we also call it as share appreciation rights. Share appreciation rights. Okay, like how this works is, let's say 100 SARs is given to employees. Okay, 100 SARs is given to employees. Okay, they will say like this. Excuse me. Like the day SAR was given, let's say the price of the share was 150. Let's say SAR will get vested at the end of 1 year. 100 SAR share appreciation rights is given to one employee, let's assume. And on the date the 100 SAR, this SAR was issued, the market price of the company share was 150. And this SAR, the company will give only at the end of 1 year, let's assume. So the market price at the end of the year, let's say, has become 200 or let's say 300. Okay, maybe let's take it as 350. From 150, the share price has become 350. So has the share price increased? Yes. How much has the share price increased by? From 150, it has become 350, means the increase in share price is 200 rupees. So how does this SAR works is, so if shares, if 100 SARs has been given, means your company has to give cash. You know how much cash will be paid out? Yes. On one share, sir, if share price increases by 200 rupees, means if one share price increases by 200 rupees, the company will give 200 rupees to the employee. How many SARs has been given? 100. So whatever is the share price increase, to that you multiply the number of SARs. This will be what here? 20,000. So 20,000 cash will be given to the employees. So how much ever share price increases by, take that increase amount and multiply it by the number of SARs which the company has given. That will be the amount of cash discharged by the company to the employee. So this is what we say, the number of cash will be given based on the share price. That's what we say. That's the reason share appreciation rights. Okay. Or in other words, maybe we call it as cash settle plan. Okay. So that means here the company has what, sir? A liability to pay cash. So you can't book a reserve. In the previous case, you booked it as SBPR because company was issuing shares. Here the company has to pay cash. They have a contractual obligation to pay cash. So you'll have to book it as share based payment liability. So it's financial liability. Oh, no. Since it's given to employees, we cover this under IND AS 102 accounting and not IND AS 109. So you'll have to book a liability here. The rest everything is same, but you have to book it as liability. Okay. So let's do a thing. Let's learn this with the help of one question. Where is that question bar? One second. Yeah, here. Question number 2. Let's go for this. A company has issued 10,000 SAR, share appreciation rights, that vest immediately. Okay, this word is important. Vesting immediately. So that means there is no waiting period. It will vest immediately. So that means you have to do the accounting on grant date itself. Do keep this in mind, because it is vesting immediately means the company has an obligation on the grant date itself. The moment grant date means on the agreement date. The moment it is agreed, company has an obligation. So you have to do the accounting on grant date itself here. Watch out for these words. To its employees on 1st April 2010. That's your grant date. The SARs will be settled in cash. Great. SAR means that only. Yeah. Using an option pricing model, at that day, it is estimated that the fair value of SAR is 95. Okay. So loss on one share is 95 rupees. That's what they're trying to say. The SAR can be exercised at any time up to 31st March 20x3. Okay. So you have given time. It is vesting immediately on 1st April 20x0. But they've given a time limit. Employee can exercise this right anytime up till from 1st April 20x0 to 31st March 20x3. So why will they want the exercise immediately? But sir, if share prices increases means employees will get more cash. So some of the employees may feel this is a good company. So if you wait for 1 more year, we may get extra cash. So every one of them may not exercise it on the same day. Some of them may have to wait also. Or some of them may like to wait also. Maximum period of waiting that the employees can do here is 31st March 20x3, 3 years. Beyond that, if they don't exercise, it will probably get lapsed. Okay. At the end of 31st March 20x1, first year, 95% of the total employees will exercise the option they are saying. 92% of the total employees will exercise the option at the end of second year. Finally, 89% vested at the end of third year. So the fair value of, they have given the fair value at the end of fair value of the SAR at the end of each year. Sir, this is a liability. For equity, there is no remeasurement concept. That's the reason we only take grand date ka fair value and do the accounting. But for SAR, it's a liability to be settled. That means we can't take fair value only on the grand date and do the accounting. There's a liability, means liability has to be remeasured at every reporting period. That's the reason they've given fair value at the end of each year. This is the end of first year, year 1 ending, year 2, year 3 ending. Okay. You need to pass the journal entry. First, you need to have the table, same table, particulars. But here you need to have grand date also, because the employees... yesterday's class, could you upload? Yesterday's, it should be there, it's a live class. It's not available. Huh? Okay, no problem. I'll ask the team to look into it. No issues. Okay. Now let's come back to this. Since the options vest immediately, the company has an obligation on the grant date itself. So you have to start doing the accounting from grant date. First column you'll have a grant date, then year 1 ending date, year 2 ending date, and year 3 ending date. That's what I've written here. Same drama, number of options expected to vest, fair value of the option, vesting period, then total expense to be recognized, expense booked previously, expense for the current year. Same table, almost every problem. Almost we've solved 25 questions in this chapter. Regular class mein, same format mein, more or less. Okay. So first thing, again, same thing. So first check, sir. On the grand date, how many SIRs you gave? 10,000. On the grand day, are you saying this many employees will not buy? No. We expect that 100% of the employees to vest because no other data is given. So 10,000 options will get vested. So on the grand date, what is the fair value? Like here told here, 95. Okay, 95. What is the vesting period? Immediately, there's nothing. That means the entire expense has to be booked in the first day itself. So 10,000 into 95. If the vesting period is 3 years, you will book it over 3 years. If there is no vesting period, means entire expenditure, you will book it on grant date itself because you got the obligation. So 10,000 into 10, loss on one share is 95. We have 10,000 shares. So totally it is 9,50,000. Have you recognized any expense previously? No, 0. So that means expense to be booked is what? Excuse me. No, is the 9,50,000 itself. This is on the grant date. On the first year ending date, what are they saying? On the first year ending date, they are saying only somewhere, 95% of the total employees will exercise, it seems. They're saying that much. Okay, you gave 10,000. All of them will not exercise, but only 95% they're saying. So take 10,000 into 95%. 10,000 is a total SAR. In that, only 95% is expected to get vested. So 9,500 options are getting it vested. Now don't take grand date ka fair value. This is a liability. So we are in year 1 ending. No? What is year 1? Year ending ka fair value. Year 1 ending ka fair value 112. So take 112. So loss on one share is 112. On 9,500, how much? 9,500 into 112. So there is no concept of vesting period here. It is vesting immediately. So total expenditure to be booked is 1064. 1064 has to be booked by the end of first year. How much have you already recognized previously? On the grand date only, you booked 950. So in 1064, 950 is already booked. So how much more we need to book? 114. So this for first year. So do the same accounting for second year. In the second year, what are they saying? Only 92% of the employees are expected to utilize this option. They're saying they gave 10,000 SAR. Only 92% are expected to vest. So that means the number of options expected to vest is 9,200. We are in second year ending now. What is the fair value of a second year ending date? 109. That we have taken over here. So the loss on one share is 109. On 9,200 shares, how much is the total loss? If you do, it is 10,02,800. How much expense have you recognized previously? 10,64. Basically, if you add these two, you're going to get 1064 only. So expense booked previously is 1064. So in 10, you have to totally recognize. By the end of second year, totally you need to recognize 10,02,000. But you already recognized 1064. So that means you have booked more. So if you have booked more means you will not book more, you will reverse. If you have booked less, you'll additional expenditure you will book. Otherwise, it's a case of reversal also. So here it's a case of reversal. In second year, you will not book the expenditure, but rather you will reverse like that. Third year, what happened? Finally, only 89% of the employees expected or vested their thing. So 10,000 into 89% is 8,900. And third year ending, what is the fair value? 114. So we have taken that. So loss on one share is 114. On 8,900 shares, it will be 10,14,600. What is the total expense booked previously? 10,02,800. 1014 has to be booked. In that 102 is already booked. So third year, again you have to book an additional expenditure of 11,800. Okay. This is the amount for which you need to pass the journal entry. But here do keep in mind, since the option vested immediately, so you need to do the accounting on the grant date itself. Okay. Thanks a lot for the efforts. Thank you so much. Honor. Okay. So now let's go for the entries. Entry here is what's the same. Employee benefit expense account debit to what? SBPR. No. You can't create a reserve. You have an obligation to pay liability here. So here you will book SBPL, employee benefit expense to share-based payment liability. First year, how much? In fact, on the grant date, how much? Not first year. Grant date, how much? 950. Have they booked 950? Yeah. And this employee benefit expenditure, you'll transfer it off to P&L. First year end, again, Say how much expenditure you need to book? 114. So have they booked for 114? Say employee benefit expense account debit to SBPL 114. Second year ending mein, how much is the expenditure we got? In fact, it's not an expenditure, it's a case of reversal. Reversal means ulta entry. To book the expense, it is employee benefit expense to SBPL. If you have to reverse, it will be SBPL account debit to employment benefit expenditure. And this employee benefit expenditure, whatever it is, will be transferred off to P&L. Okay. And third year, what is it? 11,800 you need to book. So again, employee benefit expense to SBPL, like that. So then the third year, if they say, if you have settled the amount, means the journal entry will be SBPL account debit to cash. Whatever liability is there, you will settle. That's all. So SBPL account will finally get scratched off. So that's how this particular accounting will run through. So this is your second plan, which is equity settled plan. Next is thing is equity settled plan with cash alternative. Excuse me. Okay, the next one is equity settled plan with cash alternative. So here what will happen is we'll give an option to the employee. We are so Darala Prabhu, the company. Okay, company is so nice that they are giving an option to employees. Hey macha, hey employee, take equity shares if you want, or take cash if you want. Whatever you want to take, you take. Like that, one option is given. Company is so nice that they're giving option to employees. If employees want, they can take cash, or if they want, they can take shares. If such a plan is there, means we call it as equity settled plan with or SBP plan with cash alternative. So in this case, what to do? So since the choice is with the employees, normally choice will be with the employees. If the company has a choice, basically, then you have to check the intention of the company and accordingly do the accounting. If company has an intention to settle it in cash, do cash based plan with accounting. If the company has an intention to settle in shares, do equity settled plan with accounting. But normally this will not be there in the problem. The intention to choose will be with the employee generally. Okay, that's the reason we'll do this accounting. This is more popular in examination. Okay. So if they don't give who has the intention, always assume that employee has the intention and do this accounting only. Don't follow this. Okay, this I'm just given for your reference. Okay. So now, if the employee has an option to choose, that company cannot back out and company doesn't know what he'll choose. So if this is the case, means we have to book both SBPR and SBPL. The company has to book both the SBPR and SBPL. That will be double accounting. No, sir. No. You don't book it to the total extent. There is a way, work around here. So what you need to do is you have to find out the fair value of the option, total loss under equity option. You have to find out total loss under cash option. First, find out total loss under equity option. If the employee goes for equity option, what is the total loss? If the employee goes for cash option, what is the total loss? Find out the difference. The difference is accounted as SBPR. The difference between these two is accounted as share-based payment reserve. And this SBPR, suppose the difference is 1 lakh. This difference of SBPR of 1 lakh will be accounted over the remaining vesting period or over the vesting period. Let's say vesting period is 4 years. Okay. So this 1 lakh will be booked over 4 years equally. That means every year you will book SBPR how much? 25,000. Like this. This is accounting. Okay. And then you will do the SBPL well accounting. So let's do a thing. Let's learn this probably. I've written in words, but I think better probably learned in numbers. So we'll take up one question which has this. 1 second. I'll show you that. Question number 3 we want. Where is it? Finding the question here only is big problem. So many things, no? Where is question number 3? Oh, you have found question number 2. Where is question number 3? Okay, question number 3 is here. Okay, here we got it. All right, 1 second. Let me get the solution also a little closer. Yeah, found it. Okay, let's look at this now. On 1st January 20X1, ABC Limited gives an option to its KMP. So option is given to KMP. Okay. All right, employees to either take cash equivalent to 1,000 shares or 1,500 shares. So KMP has an option. They can either go for cash settled plan and choose 1,000 shares, meaning the cash will be given based on keeping 1,000 shares ka share price, or they can go for 1,500 shares. So why have they given higher amount here, sir? Sir, obviously, sir, between cash settled plan and equity settled plan, no, employees will obviously prefer cash settled plan. The reason is cash settled plan, no. If I tell you I'll give you shares today, I'll give you cash today. What will you choose? Probably you'll choose cash. Yes, no, because share ka value may increase in future or it may reduce in future also. But cash is always safe. Yes. So that means that's the reason to make the offer lucrative or kind of favorable. No. Now you give more number of shares. equity settled plan, you'll give more number of shares. So you'll tell the employees, if you go for equity settled plan, I'll give you more number of shares. If you go for cash settled plan, you find out the value by keeping lesser number of shares. Okay, that's how you can balance the things. Because if you keep same 90% of them, or almost everybody will go for cash option only, especially because everyone likes to have the cash in hand immediately. That's the reason. All right. The minimum service period is 2 years. So there is a vesting period of 2 years. It will not get vested immediately. Okay, that means here on the grant date, is there any accounting requirement? No, we don't have to do anything, any accounting on grant date, because it is not getting vesting immediately. It is not vesting immediately. Employees have to wait for 2 years. And shares being taken must be kept for 3 years. Okay, there is an additional condition also. After 2 years, employees are eligible to buy the shares. But after buying, they have to hold it for 3 years. They cannot sell it for 3 years. So that means there is a holding restriction also. Okay, that's probably the reason why you're giving some more extra shares to them. Okay, so share alternative fair value with restriction. The fair value of the share is 102. Grant date ka fair value is 113. This is without restriction. This is without restriction. This is with restriction. Okay. All right. This is the grant date. Both are on the grant date. Fair value at the end of first year. Because on 1st January 20x1 you gave, no? So 31st December becomes your year 1 ending, and 31st December 20x2 becomes your year 2 ending. Year 1 and year 2 ending ka fair value they have given. Because here I told you, you need to account both SBPL and SBPR. So for SBPL we need every year ka fair value. So they have given that. The employees exercise cash option at the end of 20x2. So the end of second year they went for cash option. So you need to pass the journal entry. But first for the journal entry we need the expense. So let's do the expense accounting. So same table. What is the same table? Here, and here vesting period is only 2 years, so we'll have only 2 columns. First, number of options expected to vest. Where it went, right? I brought this closer, no? 1 second. Yeah, all right. First one, how many options did you give it to the employees? In fact, before this is the equity settled plan with cash alternative, no? So first you need to find out what is the fair value under equity option. So fair value under equity option is how many equity shares have you given. Under equity settled plan, you're giving 1,500 shares. And if you go for equity shares, there are some restrictions, correct? So you will take fair value with restrictions. What is the fair value of restrictions? 102. So we have issued 1,500 shares with restriction. Its fair value is 102. So what is the total loss? 153. Under cash option, what is the total loss? How many shares? 1,000. Cash option doesn't have any restrictions. So without restrictions, what is the fair value? 113. So take this. Okay, so that means what is the total loss? Here it is 153, here is 113. So what is the difference? 40,000. And difference is accounted as SBPR, share-based payment reserve. And this SBPR will be recognized over the vesting period. And here the vesting period is 2 years. So this 40,000 will be booked equally over 2 years. So every year, how much will you book as SBPR? 40,000 divided by 2, which is 20,000. So you got your SBPR portion. Okay. Now we shall account what, sir? SBPL. SBPR is related to equity settled plan. Okay, now we want a cash settled plan accounting. Now we have to do this is over. Equity ka is over. Now we have to do the cash settled plan for normal accounting. So this table relates to cash settled plan. Okay. Yeah, yesterday's marathon, I'll ask the team. Yeah, it should have got uploaded. I'm not sure why it got missed out because it was a live streaming. So we don't remove it by mistake. If someone removed from our team, I don't know. I'll ask them. Okay. Don't worry. At the end, we will merge everything and release it also once more. Okay, don't worry. Again, it will be republished. Okay. For now, yeah, you can just continue with what you're doing right now. Okay. So going back to the same accounting, first you'll find out what is the number of options expected to vest. How many options you gave to the employees? This cash settled plan we're doing. How much is that? 1,000. Did they say this many employees will not opt for it and all that? In fact, it is given to its KMP. They never said this many options will get vested, that many options. That means what is the assumption? All the options will get vested because they've not given any data. So number of options expected to vest is 100. You don't have to do any accounting on the grant date because it is not vesting immediately. Okay. So what is the vesting period here? Vesting period is 2 years. What is the fair value? Will you take grant date ka fair value? No, this is the liability we're talking about. So liability, if company has an obligation to pay cash means you have to value it at end of each year. You are at the end of first year now. At the end of first year, what is the fair value? 120. So the loss on one share is 120. On 1,000 shares, how much is it? So 1,20,000 you will get. That is the total loss to be that total loss has to be recognized over the vesting period. 1,20,000 is the total loss to be recognized over 2 years vesting period. So first year, how much is the loss? 60,000. Okay. Have you recognized any expense previously? No. So total expense for the current year is how much? 60,000. Second year, same. 1,000 options is expected to vest. But what is the fair value for second year? For the fair value of second year has become 132. So the loss on one share is 132. We have totally 1,000 shares. So what is that, sir? 1,000 into 132 will be 1,32,000. You are at the end of second year. So vesting period is also 2 years. So entire 1,32,000 you should have recognized. This is the total expenditure. By the end of second year, totally you should have recognized 1,32,000. Hence, if you want, you can do 2 by 2 at the end or leave it off. It's fine. Okay. So how much have you recognized in the previous year? In year 1, 60 is already recognized. So now you have to just recognize 72,000 more. Okay. That's all it is. Fine. Now you have to do the accounting. Both SBPL. This is your SBPL car. This portion is your SBPL. And this is your SBPR. So both clubbing, you have to go do the accounting. So what will be the accounting? First year it will be what's employee benefit expenditure account debit. What is SBPL for first year? 60. What is SBPR for the first year? 20. So that means the total employment benefit expenses will be 60 plus 20, which will be 80,000. Yes. So employee benefit expenditure 80,000 to SBPR 20 to SBPL 60. And this employee benefit expenditure, you transfer it off to P&L. This is for the first year. Second year SBPR is 20 only. But what is SBPL? SBPL is 72,000. So 20 plus 72 is 92,000. So employee benefit expenditure, which will be transferred off to P&L, is 92 to SBPL, SBPR respective amounts. Okay. This is second year. At the end of second year, what did the employees finally do? They went for share option or cash option. What? They went for cash option, right? So that means whatever SBPR you have, you're booked in SBPR, right? But they're not going for share option. So whatever you have in the SBPR, release it into your retained earnings. Release it back. You have created a reserve. You don't need this reserve anymore because employees went for cash option. So whatever is SBPR, release it into retained earnings. So the total balance in SBPR is 40,000. 20,000 in the first year book, 20,000 in the second year book. So total is 40. Release it off to the retained earnings. What did they go for? Cash option. Have you already created liability? Yeah. Here 60 of credited here, 70 of credited here. If you sum it up, it is 1,32,000. So you have a balance of 1,32,000 in your SBPL that needs to be settled. So SBPL account debit 1,32,000 to bank account 1,32,000. So all the ledgers will get closed in this particular way. This is your equity settled plan with your cash alternative. Okay, G. All right. Next. Okay. So there are some conditions. Okay. Normally, companies don't give the shares to the employees right now. They'll put some conditions that we call it as vesting conditions. Okay. So first, in fact, broadly, you can categorize the conditions to be vesting conditions and non-vesting conditions. We'll see the non-vesting part a little later. First is vesting condition. So vesting condition can be broadly classified into service-based condition and performance-based condition. Service-based condition means it's quite simple. In service-based condition, a company will tell the employees, serve in my organization for 2 years and I will give you shares. Or serve in my organization for 5 years, I will give you shares. So based on the service period, you will go on giving the options. That is your service condition. So let's say company tells the employee, stay in my organization for 3 years and I will give you shares. Only those employees who will stay for 3 years will get the shares. Those of them who don't stay, if they quit within 3 years, they will not get the shares as long as like that. So if the condition is met, those employees meeting the condition will be eligible, will be getting the shares. Those of them who don't fulfill it will not get the shares. That is your service condition. Okay. But the thing you need to remember from accounting per se for service condition is, sir, within the vesting period, here you know this, right? Here, if the service condition is 3 years, that means indirectly vesting period is 3 years, right? Within vesting period, you can increase the expenditure, decrease the expenditure, you can reverse it, you can do whatever you want. Okay, increase, decrease, reversal. Within the vesting period, you can play around whatever. We saw in one of the problems there. First year, if you have booked more expense, second year, you can reverse it. Third year, if you have booked less expense, you can increase it. So the increase, decrease, reversal and all you can do within the vesting period. But once the vesting period is over, you cannot reverse any expenditure. Whatever expenditure you have booked, let's say vesting period was 3 years. You thought 100 employees will buy the shares. Okay. But eventually only, let's say 80 employees purchased. That means you have booked the expenditure on how many employees? 100. Vesting period is already over. After that, 20 employees did not buy. For that, you can't do anything. Once after the vesting period, employee benefit expenditure cannot be reversed. Within vesting period, you can do whatever you want. Once the vesting period is over, right? If any employee does not exercise, you cannot reverse the expenditure. Because even after the vesting period, you will have something called exercise period. Vesting period is basically waiting period. After that also, no, sir, like imagine a vesting period is 3 years. The company has 1 lakh employees. Now, can company tell the employees, all 1 lakh employees, if you want to buy the shares, buy today only. Like that, can they tell? No. 3 years is the vesting period. 3 years, everybody has to wait. After that, they will give you extra window. Because number of employees is more means they will give some extra time also. The company may tell, you can take extra 1 year time to decide whether you want to buy or not. That extra time, we call it as exercise period. Okay. So for booking the expense, we don't take exercise period into consideration. We only take vesting period into consideration. And whatever expense you have booked in the vesting period cannot be reversed later on. That is for the service condition. Okay. Next is performance-based condition. Performance based conditions could be market related or non-market related. Market related means here the company will tell the employees, I will give you the shares provided my market price of the share increases by 50% or it increases by 30%, like this. So if the share price achieves a certain target or reaches a certain target, then shares will be given to the employees. If such is a condition, means such a condition we call it as market related conditions, like that. Okay. So in market related conditions, you cannot increase or decrease the vesting period. So let's say like company told the employees, I will give you 1,000 shares provided share price increases by 50%. Now nobody can estimate when the share price exactly will increase by 50%. It could happen after 6 months also, after 6 years also. We don't know. So here, how do you do the accounting is company has to estimate. The moment they give this plan to the employees, the company has to estimate in how many months or in how many years the target is expected to get achieved. The company feels based on that target, based on the previous history or whatever, the company feels within 3 years, 50% increase will happen, meaning the target will be met. Initially, when the company gave out this plan, company feels within 3 years, the target will be met. That means vesting period will be taken as 3 years. Thereafterwards, let's say target got achieved in 5 years. Okay, you cannot increase the vesting period. You have taken 3 years period as vesting period. No, book the expense within 3 years. Okay, you cannot increase the vesting period. Usually, you cannot decrease the vesting period also, but decrease of vesting period, you can do it in one case. Like initially, like in my example, what was the original vesting period? Originally, when the shares was issued, company thought that the shares target will get achieved in 3 years. But look at the Vastu, sir. In 2 years only target achieved. At the end of second year only target got achieved. Now, in this case, this we call it as acceleration of scheme. Acceleration of scheme means achieving the target sooner. If the target is met sooner. So now the vesting period will not be taken as 3, it will be taken as only 2. Now the expense will be booked only in 2 years. Okay. In this case, you can reduce it like this. Fair enough? You cannot increase the vesting period, but if you want, you can decrease the vesting period in case of an acceleration scheme. So if the target gets achieved sooner, you can reduce the vesting period and make it as 2. So in this case, what now? First year, you already booked the expense. So whatever is remaining expenditure, entire remaining expenditure will be booked in second year only, like that. Okay. So third year, nothing will be booked because target is already achieved, like that. So that is this. And in this particular market related condition, once the expenditure has been booked, reversal is absolutely not allowed. Once you book the expenditure, it is gone. It's like Tirupati Hundi. You put the money, gone means go in. Okay, like that. So reversal of employment benefit expenditure here is not allowed at all. Okay, because fair value of the option when you find out, no, all these factors will be considered. Hence, reversal of employment benefit expenditure will not be allowed in these cases because the fair value options, whatever we're finding, no, we'll keep this into consideration and accordingly you'll find out the fair value. Okay. All right. Another one is non-market related condition. Non-market related condition means the target could be some internal parameter like EBIT, EPS, sales, EBITDA, etc., etc. So like let's say the company tells the employees, I will give you the shares provided EPS increases by 50% or my profit after tax increases by 100%, like that. If that is the case, means this is not market related because all this is, all this is in company's hands. No, okay, it's not dependent exactly on the market, right? Share price is most market driven. So these are mostly influenced by company's action. I'm not saying totally, but mostly. So hence this we call it as non-market related conditions. Okay, so these are your vesting conditions. Okay, next is your non-vesting conditions. Non-vesting conditions means, let's look at a small example. Actually, this is no impact on your SBP plan. This is just for theory if at all they ask. So let's look at this example. Let's say company has given ESOP to employees who serve for 2 years. Those employees who serve in the organization for 2 years, company feels they will give ESOP or they will give shares. But company has put forth one more condition saying they will give the shares only when the revenue of the company crosses 50 crores. Right now, the revenue of the company is not 50 crores, it is much lesser. So company has put two conditions. We will give the shares to employees only for those employees who serve minimum 2 years. And we will give the shares to employees not now. After 2 years, if any employee completes 2 years, immediately we will not give them the shares. We will give the shares only when the revenue of the company exceeds 50 crore, whenever that is. If it exceeds in 2 years only, we will give it in 2 years only. If it exceeds in 5 years means we will give it in 5 years. If revenue crosses in first year means we will not give. We will give it only in second year. Okay, the main condition is 2 years. Employee has to serve for 2 years and revenue has to exceed 50 crores, like this. Suppose one employee is there, sir. He served for 3 years. That means, is he eligible to get the shares? Yes. And he quit. He quit because the revenue of the company still was not achieved. By the end of third year also, no, sir, revenue of company did not exceed 50 crore. So company, though all the employees have fulfilled their obligation or service criteria of 2 years, company has not still given the shares because the revenue has not crossed 50 crores. Let's say in the fourth year, okay, the revenue of the company crosses 50 crores. And to this particular employee who has quit, to him also we gave shares. This particular employee is already quit, but to him also we gave the shares. If that is the case, means this revenue related condition, we call it as non-vesting condition. That means it is just what? It is just a dummy condition. Okay. So we just, I mean, it is what, like, see, this particular employee is no more in the organization, but if still he's getting, means that revenue related condition was just for the payment date. Okay. So that's the reason that particular thing we call it as non-vesting condition. That is irrelevant for our booking of SBB plans. That is what it is. Okay. All right. Then we have two more concepts. After that, I think we are more or less through. Okay. Modification and cancellation. Sir, can share-based plan be modified, sir? Yes, sir. Yes, sir. Yes, sir. Part 3 video will be uploaded, sir. Leave that, sir. Come back to this, sir. Yeah, I'll check with the team, sir. Don't worry about that, sir. Give some time, sir. First, I'll finish off this, sir. After this class is over, I'll definitely check on that. Yeah. Okay. Now coming back to this particular example, modification and cancellation. Can a share-based plan be modified or cancelled? Yes. Okay. First, let's look at modification. Let's say share-based plan has got modified. Okay. So now, sir, first you need to check whether the modification is unfavorable to employees or favorable to employees. Unfavorable means increase in the vesting period. From 5 years, you increase the vesting period, etc., etc. If you're doing that, means it's an unfavorable modification. Okay. If you're doing unfavorable modification, then that is ignored. Or you can do it, okay, but for accounting purpose, that is ignored. The way you are booking the share-based expenses still now, let it continue. You don't have to think that any modification is done. So if you are doing any unfavorable modification, just ignore it totally for accounting per se. You don't have to do anything. Whatever you've been doing till now, continue with the same. No change. That's all. That means this problem is as good as you don't have to do any extra treatment. Whatever you're doing, continue. However, if you're doing any favorable modification for employees, favorable modification means giving some extra shares, reducing the vesting period, like that. Okay, like that, if you're doing any favorable modification, that means employee will get additional benefit. If you're doing favorable modification for employees, means employee will get additional benefit, but company has to bear additional cost. Benefit for employee is additional cost for the company, no? So in this case, what you have to do is you have to split it into two parts. One is your original plan. Okay, for original plan, whatever you have already put up the table and you've been doing the working, continue the same thing. For your original plan, whatever you've been doing, continue the same thing. Now you did some modification and you're getting additional cost. No, whatever additional cost you get, that has to be amortized over the remaining vesting period. Let's say original vesting period was 4 years. After 2.5 years, you did some modification, and due to this, you got an additional cost of, let's say, 1,50,000. Okay, or yeah, you got an additional cost of, let's say, 1,50,000. You did a favorable modification for employees. So for employees, you are giving extra benefit, means company is suffering extra cost. That only we're calling it as additional cost. This, whatever you're doing for originally whatever you made up a table and you're doing the accounting, let it continue. For this additional cost, what is the remaining vesting period? Original vesting period was 4 years. 2.5 years is already passed. So remaining vesting period is how much? The remaining vesting period is 1.5 years. In 4 years, 2.5 years is already over, means 1.5 years is remaining. So this 1,50,000 will be amortized over 1.5 years, like that. So that's what I've written over here. Additional cost will be amortized over the remaining vesting period. On the original part, continue whatever accounting you are following, continue with the same. Only this additional cost, you amortize it over the remaining vesting period. Okay. If you do the modification at the end of second year, then you will book additional cost in the third and fourth year. In this example, vesting period is 4 years. No. So if you do the modification at the end of second year, then the remaining period is 2 years. So additional cost, you will book it in year 3 and year 4 equally. You have to first calculate and accordingly book it. Okay, sir. All right, that's about this. No additional cost, but only vesting period if it is reduced. Then revise vesting period and accordingly account employee benefit expenditure. I think this we already discussed. No? Okay, let's say original vesting period was 5 years. In year 2, no sir, in year 2, so 2 years is already passed. That means remaining vesting period is 3 years. Okay, all right. So what the company did is, actually, let's modify. I think this will not hold good. Let's say in year 2, vesting period was reduced from let's say sir, original vesting period was 7 years. Okay, let's say original vesting period was 7 years. 2 years is already passed. That means the remaining vesting period is how much years? 5 years. So in second year, what the company did is they reduced vesting period to 3 years. They reduced vesting period to 3 years. That means now the employee in 7 years, 2 years is over. That means he has to wait for how many years? 5 years. They did a modification and told the company need not wait for 5 years. He need to wait only for next 3 years. If this is the case, means now you will book the expenditure over the remaining 3 years only. First 2 years is already passed. Now you will book the remaining expenditure over 3 years. That means totally you will book the expenditure only over 5 years. So vesting period is reduced means we know the simple funda. No? Employee benefit expenditure has to be booked over the vesting period. So vesting period is reduced means you will book the expenditure, employee benefit expenditure over the reduced vesting period only. Like that. That's what I've written it over here. All right. So let's take up one question in this regard. Let's take up question number 30. Excuse me. A Marathon company issued 150 share options to its 1,000 employees. Okay. But subject to service condition of 3 years. So the vesting period is 3 years. They have to wait for 3 years, then only they will get. The fair value of the option was calculated as 129. So grant date ka fair value 129. Below are the details and activities related to SBP plan. First year 35 left. Further 60 are expected to leave. Great. Share option repriced. Some modification they did at the end of first year. As market value of the shares has fallen and fell to fair value fell to 55 rupees. Okay. After the repricing, they are worth 80. Hence, expense is expected to increase by 30. Here, check this word. Expense is expected to increase by 30. That means what, sir? This is your additional cost. The loss, basically. You have done some modification, and due to this, the company is expected to suffer an additional cost or an expense is expected to increase by 30 means this 30 is your additional cost. Additional cost per option. How many such options we have? 150 options, and all those options you have not given to one employee, you have given it to 1,000 employees. So okay, right? In the previous and the original expenditure, the loss on one share is 129. That is your grant date fair value. Due to modification, you are suffering 30 extra. So it is not 129 anymore. It is 129 and 39. So this is due to additional cost. Okay, you did this at the end of year 1, and you know the funda. If you do the modification at the end of year 1, whatever additional cost you're going to get, that will be booked over the remaining vesting period. So total vesting period was 3. In that 1 year is already over. So remaining vesting period is 2 years. So this additional vesting cost will be booked equally over year 2 and year 3. Okay. Or equally, you'll have to find out. I'll show you the accounting. Hang on. Yeah, that will be better. Okay. Okay. Year 2, 30 employees left, and further 36 employees are expected to leave. In year 3, 39 employees left. So how the modification and repricing will be accounted? Sir, I already told you. Whenever there is a modification, split between first whatever you're doing, keep that table and entry as it is, and for additional costs, bring a separate working note. You can do both the working notes, original and additional cost, inside the same table only. Sometimes data may confuse you, or you may not know how to present it. So the best way to avoid confusion is keep the original data separately, keep the additional cost a separate working note. Though it will take a minute more, you will avoid some arithmetical mistakes or some problems, because when you're solving, suddenly if you get stuck, then you have to cancel everything and redo. That may take more time. So rather than that, keep this separate, original separate, modification or accounting separately. So things becomes little easy. First, let's do the original accounting. Think that there is no modification. So that's what they've written here. Employee benefit expense without modification. If you have not done modification, how the accounting will look like? What is the vesting period? 3 years. Okay, same thing. First is end of first year. Is option getting vested immediately? No. If option got vested immediately, we would also bring one more column called grant date into our table. Here, that's not the case. Okay, so at the end of first year, so how many options is expected to vest? How many employees you gave the option to? 1,000. In first year, how many left? 35. How many are expected to leave in the first year? 60. So in 1,000, may say 35 already left, 60 are expected to leave. These are the number of employees, and each employee have been given how many options? 150. So total number of options expected to vest is 135. And what is the fair value on the grant date? They've given it to be 129. Fair value of grant date, I can copy across all the numbers because this is equity settled plan. For equity settled plan, there is no remeasurement concept. That's the reason, same thing you can copy. This is a loss on one share, and we have this many shares. So total loss you have to book over the vesting period. Here, what is the vesting period? 3 years. Okay. So 1,35,750 into 129 if you do, you're going to get total expenditure. You have to book it over 3 years. So we are in the first year. So 1/3 you need to book. So which is 58 lakh. You have not booked anything previously. So because we are in the first year only. So hence first year expenditure is 58,37,250. That way. Okay. Now we come to the second year. Totally 1,000 employees. First year mein 35 already left. Second year mein check how much left. 30 again left. 36 further are expected to leave. So at the end of second year, we know that 30 more employees have left, and we are expecting by the end of second year that 36 more will leave. So 35 left in first year, 30 left in the second year, 36 more are expected to leave in the third year. So if you do this, you're going to get number of employees, and each employee can buy 150 shares. So this is the number of options expected to vest. The loss on one share is 129. You have to book this over 3 years. We are in the second year, so 2/3 of the expenditure needs to be booked. So by the end of second year, totally 1,15,97,100 should have been booked. Have you already recognized any expense previously? Yes. In that 58, you already booked. So additional 57,59,000 something, or you need to book it in the second year. Okay. Third year. So how many options left in the third year? 39. So 1,000 employees. First year 35 left. Second year actually 30 left. Third year actually 39 left. So this will give you a number of employees. And each employee can buy 150 shares. If you do this, you're going to get total number of options expected to vest. And the loss on one share is 129. And we are in the third year. So that means the total expenditure has to be recognized. If you want at the end where you can do 3/3 or ignore it. Okay. This is the total expenditure expected to be booked by the end of third year. This much totally should have booked. But you already booked how much already? 1,15,00,000 you already booked. So additionally, you need to book 57. So this is what? Original expenditure without modification. This much the any which way you have to do it. Okay. Now that's all is there. No, you did some modification also. And due to modification, you are getting an additional cost of how much? 30 per option. Okay. And do remember this 30, you may have done this modification at the end of year 1. Okay. But you have to book this expenditure when? Over the remaining vesting period. That means you will book this expenditure only in end of year 2 and end of year 3. Okay. So now let's put up the additional cost due to modification data. So when did you do modification? Year 1 ending. The remaining vesting period is 3 was the original vesting period. 1 is already over. So remaining vesting period is 2 years. So now what is the additional cost? Sir, the loss is additional cost is 30 per option. For one option, the additional cost is 30 per option. That means we want to know how many options will get vested. No. Okay. Now don't take year 1 ka data. Though you might have done modification in year 1, are you booking that additional cost expenditure in year 1? No. Additional expenditure you will book only in the second year. Now you will book this additional expenditure only by the end of year 2. So by the end of year 2, you know some more information, right? By the end of year 2, in 1000 May, 35 employees have already left, 30 employees have already left, and 36 are expected to leave. So take this number. So 1000 minus 35 minus 30 minus 36. If you do, it is 899 employees. So you have to take this. So this is 899 employees are expected to leave. Okay, sir. Though you did modification at the end of year 1, you will book this additional cost by the end of year 2 and end of year 3. And by the end of year 2, you already know that only 899 employees are expected to stay in the organization. That's the reason you take this data. Don't take year 1 ka data and book the expenditure. That will be wrong. Okay. So do keep this in mind. This is one mistake which you can go wrong. That's the reason calling it out. Okay. So this is one. This is the number of employees, and each employee can buy how many shares? 30. In fact, 150. And what is the additional cost now? For one option, if you do this 899 into 150, if you do, you're going to get 1,34,850. That is the total number of options expected to vest. And what is the additional cost on one option? Additional cost on one option is 30. So multiply by 30 if you do, you're getting 40,45,550. These multiplication is giving you 40,45,500. That is the total additional cost. Total additional cost, you will book it in second year only. You will book it in second year only. Oh, no, you will book it over the remaining vesting period. Your remaining vesting period is 2 years. No? So you'll amortize this over 2 years. So divide by 2. How much is that? You're going to get 20,22,750. Like that. Okay. So second year you'll have to book second year you'll not book 57,59,850. You'll also book an additional cost of 20,22,750. So these two you will add. So if you add these two, how much are you going to get? So these two, if you add total expenditure or total employment benefit expenditure for second year will be 77,82,600. Similarly, third year, this one and this year. Okay. Total, I mean, again, now what's it? Third year again, do the same calculation. Okay. Fine. In third year, how many employees are there? This if you multiply. 1000 minus 35 minus 30 minus 39. You do that. That you're going to get 896 into 150 you do. And additional cost per employee is 30. Okay. So you're going to get this number. I think, yeah. I think somewhere 1 minute. Yeah, I think 1 second. Here, I think I've written a wrong number there. So just like maybe 1 second, I just proved it. 1000 minus 35 minus 30 minus 39 into 150 into 30. So this you're going to get 40 lakh minus 20,22,750 is actually this is not. This number is wrong. That's what I was just checking there. Yeah, so this is 20,09,250. Okay, how? So third year, mein how many employees are there? Third year, mein 35 left in first year, 30 in second year, 39 in third year. So 1000 minus 35 minus 30 minus 39. So the number of employees is 896. Okay. And each employee can buy 150 shares. Into 150 you do. And the loss on one share is 30 rupees. So into 30 you do. So the total loss is 40 lakh. If you do this, you're going to get 40 lakh 32,000. That is your total additional cost. In that 20 lakh 22,750 is already booked in year one. So minus 20 lakh 22,750 you do. You're going to get how much? 20 lakh 9,250. So that is additional expenditure. You need to book it in the third year. Okay. Third year, my normal expenditure is 57,500 and additional expenditure is this much. So if you add these two, you're going to get 77 lakh 49,750. Like this, for this you'll pass the journal entry. Journal entry you can pass as one. But accounting wise, I would personally suggest. I think ICA has done it together in the same table. Okay, here in the solution. If you are comfortable, if you want, try and solve once. If you're comfortable, try to put it in the same table. I feel it's better if you can show it separately so that unwanted mistakes can be avoided. That's my personal view. Rest is your choice. Okay. Yeah, so that's what they've done. So don't worry about ICA presentation. Each thing they'll do it separately. If you want, you can just reconfirm the answer. How much did we get? 58, 37, 250. And the second year, we've got how much? Second year, how much did they get? In fact, they've given separately only. In fact, they've also got the same answer, 57.59 and 57.40. Yeah, 57.59 and 57.40. They've shown it separately. They've not clubbed. But journal entry, you can pass it separately. What's the journal entry you'll pass? It's still a share-based plan, no? So the journal entry will be employee benefit expense to SBPR. Okay, for the first year, you'll pass the journal entry for this amount. Second entry, employee benefit expense to share-based payment reserve for this amount. You can collate and pass one entry. Then employment benefit expense to share-based payment reserve for this amount in the third year, like that. Okay, fine. That's about your modification. So simple funda. If you've done modification, if it is unfavorable, ignore it. If it is favorable, unfavorable to who? If it is unfavorable to employees, then ignore. If you don't have to do anything extra, whatever you're doing, continue with that. Then if you have done a favorable modification, that means employee will get additional benefits. So company will bear additional cost. That additional cost will have to be booked over the remaining vesting period, like that. Okay, that's all it's a fund. Okay. Okay, so that is one. Next, so we talked about modification. There is one more parallel thing called cancellation. Cancellation. Okay. So company had given some share-based payment plan. Initially, vesting period, let's say, was 5 years. 2 years, everything was going smoothly. Third year, no, sir. Like now, right now, Paytm, Byju's, they're all suffering heavy losses, no? Okay. I'm not saying they'll cancel their SBP plans. I'm just saying, okay. So suppose 2 years, things were smooth. In the third year, company started suffering huge losses. A lot of bad noises, too much of losses, blah, 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 too much of negative news around the market. So company decided it is not worth continuing this SBP plan. Let's cancel. Because P&L will take a hit. When employee benefit expenditure transferring to P&L means loss will increase, no? And all this will be small, not small number. Okay. Company feel it is not in our hands right now to kind of go through with this plan. We don't have that kind of money power or whatever it is. So they decided to cancel, let's assume. So whatever SBP plan they had, they decided to cancel. In that case, what to do is the accounting now. So previous case was modification. Modification is alteration. Cancellation altogether putting a full stop and saying, sorry, that's all. So if that is the case, means what you have to do. So first I'll tell you 1 or 2 pointers, then we will directly apply it in one other question. So if you have done any cancellation, okay, let's say original vesting period was 5 years, my example just now, right? How many years already over? We did the cancellation, let's say at the end of second year. At the end of second year, we cancel the plan. That means how much expenditure is remaining? 3 years expenditure was remaining because you booked the expenditure over vesting period. If you cancel the plan, no, whatever expenditure is remaining, you have to book it in the second year end only. The day you cancel, doesn't matter which year, the year in which you cancel, on that year, entire expenditure has to be booked off, right? The entire 5 years, here vesting period was 5 years, no? Entire 5 years expenditure has to be booked. That means total, sir, no. Sir, you're at the end of second year, means second year expenditure, I'm assuming is already passed. How much more expenditure you are planning to delay? 3 more years expenditure you are planning to book it in future. This 3 years expenditure also you have to book it in second year only. Meaning 2 years already booked plus 3 years which you are planning to book in future also you have to book it on the cancellation date itself. That means expenditure booking you cannot escape. Okay. Even if you cancel the plan entire in totality, 5 years expenditure has to be compulsorily booked no matter what. That's one. Okay. Now second one is on the cancellation date, find out the fair value of the scheme. They'll give you the fair value. So find out the fair value of the scheme, total fair value of the scheme on the cancellation date. Normally when you cancel, they don't cancel it just like that. There will be some settlement. They'll pay some money to the employees and say, hey employee, take about 50 lakh rupees, let's settle this plan. So they would have given some settlement price. So compare that fair value on the cancellation date with the settlement price, and the difference will be accounted as a gain loss. If you have paid more than the fair value on the cancellation date, then the company has suffered a loss. If they paid less, means they have suffered a gain. Okay, and whatever balance remaining and still in SBPR, that can be transferred off to retained earnings. Can be allowed, should be transferred off to retained earnings. Like, okay. So let's do a thing. Whatever, I think all these are better learned with the help of numbers, no matter what we say. Yeah, if you've done it, you'll be able to understand it. If you're doing it for the first time, I think these are better learned with the help of numbers. So which question, pa? Yeah, I think question number 14. Huh? Yeah, question number 14. But where do I have this? 1 minute. Yeah, here I have. Yeah, I think we'll go through this way. Okay, question number 14. Anara Fertilizers Limited issued 2,000 share options to its 10 directors. Okay, so totally 20,000. 2,000 share options to 10 directors they've given for an exercise price of 100 rupees. Okay, this share exercise price means, 1 second, 1 minute, low battery, 1 minute people, I'll plug the charger in now. Sorry, was low on battery, so I just plugged the charger. Okay, coming back to this question. So they've issued 2,000 share options to 10 directors for an exercise price of 100. Exercise price of 100 means the shares are not given at free of cost to the employees. They have to pay 100 rupees. That's it. That's what we mean by exercise price. Sometimes the employees may give, the company may give the shares to the employees at free of cost. Sometimes they may collect money also. That depends on each company. Okay. All right. This is irrelevant for us. Leave that. Directors are required to stay with the company for next 3 years. So this is your vesting period. Okay. Fair value of the option estimated is 130. So we assume that this is on the grant date ka fair value. They don't mention anything. Expected number of directors expected to vest the option is 8. Though we give the option to 10 directors, we feel 2 of them will quit and only 8 of them will avail this particular option. During the year 2, okay, it's not necessary they have to quit. There's an option, people. If the 2 of them want, they could be still working in the organization and still say, I don't want to buy the shares. That is their choice. Okay. That's fine. All right. But company feels 8 directors will avail, means we'll book the expenditure on 8 directors only and not 10. During the year 2, there was a crisis in the company and the management decided to cancel the scheme immediately. Okay. Second year, they want to cancel the scheme altogether. It was estimated further as is below. The fair value of the option on the cancellation date was 190 rupees. Okay. Market price is irrelevant. Leave that. There was a compensation which was paid to directors and only 9 directors are currently in employment. Okay. One of them already quit. So 9 are there now. So we thought 8 will avail, but actually, unfortunately, it turned out that 9 are still there in the employment on the cancellation date. At the time of cancellation, it was agreed to pay an amount of 95 per option to 9 directors. Okay, this is a settlement price. Normally, there is a cancellation, there will be some settlement also. So how should this cancellation be accounted? Okay. So first year, no drama, no. So first year, we'll do the normal accounting. Okay. So same thing. So this is your question number 14. First, number of options expected to vest. How many directors are there? 10 directors. 10 directors, but we expect first year may company expected that all the 10 directors will buy. No, company expected that only 8 directors will avail. And how many options was given to directors? Each director had an option to buy 2,000 options, and we expect 8 directors to utilize. So the number of options or number of shares expected to get bought out is 16,000. Okay, that's fine. Fair value of the option. Fair value per option on the grant date was 130, which we have taken. The vesting period is how many years? Initially, I think they told vesting period is 3 years. So first year may no drama. So we cancellation drama and all came in the second year. First year we are unaware of. So the vesting period is 3. Okay. So 130 is a loss on one option. On 16,000 it will be 4,80,000. That or in fact I think more. 16,000 into 130 if you do it, it's 20 lakh 80,000. The 20 lakh 80,000 has to be booked over 3 years. So divided into 1 by 3 if you do, you're going to get 693,333. We are in first year, nothing has been booked. So entire 693 will be booked in first year itself. Okay. Now second year, man. Second year, you did the cancellation of plan. Though in the first year, company thought only 8 directors will avail the option. At the end of second year, company cancelled the scheme. And how many directors are actually in employment? Not 8, but 9. Yes, no, that's what they said. So that means you will take 2,000 into 9, which is 18,000. Because 9 directors are actually there. And each director has an option to purchase 2,000 shares. So it will be 18,000. We'll still take the grand date fair value only. So how much it will be? 18,000 is the number of option. And the loss on one share is 130. Now, sir, scheme is cancelled. When the scheme is cancelled, do I want vesting period and all? No, the funda is very clear. When the scheme is cancelled, on the cancellation date, on the every total employment benefit expenditure has to be booked. There is no more concept of vesting period now. The moment you cancel the scheme, entire expenditure, whatever you had to book, you have to book it in that year itself. So the loss on one share is 130. On 18,000 shares, if you multiply, you're going to give 23,40,000. You don't have to multiply anything because full expenditure has to be accounted. And full expenditure is how much? 23,40,000. By the end of second year, totally 23,40,000 should be accounted. In this 23.4, have you already recognized something? Yeah, 693 already accounted previously. So how much more you need to book in the current year? 1646, 667, you need to book it in the second year. That will accounting. So no matter what you do, total expenditure or total employment benefit expenditure has to be booked. Since you cancel this in the second year, total expenditure will get booked in the second year itself. Okay. Minus whatever is recognized in the previously you will book. And that will be the expense for the current year. Okay, sir. All right. This is one part of the scheme. And since you have done some settlement, you have to see when is there any gain or loss on settlement. So for this, what you do is find out the fair value on the settlement date. On the cancellation date, what was the fair value of the option? The fair value of the option on the cancellation date is 90, meaning the loss on one share was 90. And how many options are there? 2,000 options to 9 directors. Yes, there are 9 directors. Each of them can buy 2,000 shares, and the fair value of one option on the cancellation date or date was 90. No? Yeah, right. 1 second. I think I have given first here. Sorry, my bad. This one. Okay, fair value of the option on the cancellation date is 2,000 into 9 into 90. That's what we have taken here as a 90. Okay. All right. So the fair value is how much? 16,20,000. That's a fair value of the option. Sir, if the value of the option is 16,20,000 means ideally how much you should give? That much only. But how much did the company actually pay? How much did they settle for? They paid 95 per option. To how many directors? 9 directors. And each director had an option to buy 2,000. So 2,000 options are there, and each director can buy 2,000 options. So there are 9 directors. So 2,000 into 9 is 18,000 option. And on one option, the company paid 95 rupees. So into 95, you do how much is that? 17,10,000. Company actually paid 17,10,000. The fair value of the option on the cancellation date is only 1620, but the company paid 1710. So the company paid more. Yes. So the difference, whatever it is the difference between these two. How much is the difference between these two? 90,000. That is a loss which will be transferred off to SPL account. Like that. Okay, Saru. Okay, this is the loss basically because value is only 1620, but you paid 1710 means you paid extra means it's a settlement loss which will be transferred off to P&L account. Now the closure entry. For this entry, I think you know what the journal entry is. Here you will pass employment benefit expenditure to SBPR, and then again employment benefit expense to SBPR, and the employment benefit expenditure will be transferred off to P&L. Now how much is the balance in SBPR? These two. If you add these two, obviously you're going to get 23,40,000. Correct now. So SBPR has a credit balance of 23,40,000. Are you settling this in shares? No, you paid money and you settled. So that means SBPR drama is not required. So you need to close. So you'll write SBPR account debit 23,40,000. Okay. To what? To equity share capital? No, you are cancelled the plan and you settle this by cash. How much cash you paid? Cash or bank you paid? 17,10,000. So to bank you will credit this much. Correct. On settlement, did you make any loss? Yeah, you made a loss of 90,000. So that means you will debit SBL to the extent of 90,000. Any balancing figure is nothing but any balancing figure in SBPR should be transferred off to retained earnings. So this is nothing but a balancing figure. That's all it is. So this wala account. Okay, in case of cancellation. Okay. Just as a recap. So the day you cancel, whatever expenditure is remaining, in that entire such remaining expenditure has to be booked in the cancellation year itself. This is one part of the equation. Second part of the equation is on the cancellation date, find out what is the fair value of the option. Usually cancellation comes with some settlement. So compare the settlement price with the fair value of the option on the cancellation date. So if you're paid more than the fair value, then the company has suffered a loss. If they're paid less than the fair value, it's a gain. So there's a settlement gain or loss has to be accounted in SPL. So if there's still, like this will be the journal entry if in this case. SBPR needs to be closed by debiting. Since you have settled, you will credit bank. If this settlement loss means loss has to be debited, so you will debit SPL. Still, if there is any balancing figure, you will release that. That is an excess amount of SBPR that will be released into retained earnings, like that. Okay. All right. So that's all is one more I think was there. 1 second, hang on. Yeah, I think this question I'd like to discuss, not solve, just discuss one extra point. Modification we just now discussed. In modification, you will get some additional cost. In the previous problem when we did, they only told additional cost was 30 per option. Sometimes that additional cost will not be directly given to you in the question. Okay, they'll ask us to calculate. How? Just check this problem. Like this, they will mention. In September 20, here, in this company, the company has done some modification. Modification they've done since some September. I'll only take the relevant data. Okay. In September 20x2, when the fair value of the option was 0.90, on this day modification was done. On that day, the fair value was 0.90. The directors repriced the option, and this caused the fair value to increase by 1.05. Fair value is basically loss that they're talking about. So on this modification date, fair value was 0.90. They did some repricing, meaning they did some modification. Due to this, fair value got increased to 1.05. So modification is given, but additional cost is not given. So the difference between these two, the fair value before was 0.90. After repricing, it has become 1.05. So what is the difference between 1.05 and 0.90? 0.15. That is nothing but additional cost per option. Sometimes directly they'll give you, sometimes we have to calculate like this. Rest of the steps same. In this problem, the loss on one option is 0.15 multiplied by the total number of options expected to vest, and you will get the total additional cost and amortize that over the remaining vesting period. That's in this problem, that is the only change. Okay. All right. I think questions we have done everything. 1 minute. Yeah, I think there's one more small concept. Group share based plan. Group share based plan means to subsidiary ka employees. Employee belongs to subsidiary company, but holding company is issuing the shares. Or employee belongs to holding company and subsidiary company is issuing shares, like that. One company ka shares, employee ka other company is issuing the shares. That we are calling it as group share based plan. So if this is the case, means how to do the accounting. First, before you get to the accounting, first check whether there is an obligation to reimburse or no obligation to reimburse exists. Obligation to reimburse is there or not there. Meaning, first let's say holding company will give shares to subsidiary company ka employees. Holding company will give its shares, holding company ka shares to subsidiary ka employees. Later, it will recover money from subsidiary company or it will recover something from subsidiary company. If this is the scenario, means obligation to reimburse is there. Meaning first holding company will issue shares, later on they'll take it back in some form. Maybe in the form of asset or in the form of cash, whatever. In some form they'll take it back. If that is the case, means we say obligation to reimburse exists. Or another way, holding company will issue shares to subsidiary ka employees. Holding company will give its own shares or its company ka shares to subsidiary ka employees. And after that they will forget. Holding company is so nice. They are not asking anything in return from subsidiary company. If that is the case, means we say there is no obligation to reimburse. So before you get to the accounting, first you need to check whether obligation to reimburse is there or it is not there. So if obligation to reimburse, if it is not there, then how to do the accounting? Okay. So subsidiary company I'm calling for presentation purposes S over here, and holding company I'm calling it as H. Okay. So simple thing, whichever company is receiving service, that company will book the employee benefit expenditure. Because in these sort of things, you're giving shares because employee is serving. So you will book employment benefit expenditure. The company receiving service, whichever company is receiving the service, they will book employment benefit expenditure. So check this first. Okay. So in this scenario, service is received by H. So it is S ka employees. Employee belongs to S. So he is giving service to S. So S has received the service. But who issued the shares? H gave the service. So holding company is issuing the shares to subsidiary ka employees. And subsidiary ka employees is working for subsidiary only. So who is receiving service? Subsidiary company only. Okay. So in the entry, in the books of S, what entry needs to be passed? So whichever entity is receiving service, they will debit employment benefit expenditure. Here S received the service from employees. So they will write employment benefit expenditure account debit. Can they credit SBPR? Normally that's the entry we pass in equity settled plan. Employment benefit expenditure to SBPR. Can S credit SBPR? No, because they're not issuing shares. Holding company is issuing shares. So instead of crediting SBPR, here, does S have any obligation to H will give with the shares? After that, does S have any obligation to pay H? No. That means here, if we have done all this adjustment already, S will treat this as an equity contribution from parent. You will simply credit capital contribution from parent. That's all. Okay. All right. You have received more money from, or you have received some equity contribution from parent. So till you, as long as you have holding subsidiary relationship, this account will continue, it will not get cancelled like that. What about the other entity, H? What will they do? Did they receive service? No. That means they can't debit employment benefit expenditure. Whichever entity is receiving service, they will debit employment benefit expenditure. H did not receive service, so they cannot debit employment benefit expenditure. But H is planning to give shares. They have not yet issued shares. They will probably issue it in future. That means H will credit SBPR, share-based payment reserve. What will they debit? H will give shares and nothing they will get in return. So the H will treat it as an investment made in subsidiary company. So they will pass the journal entry investment in S account debit to SBPR. Okay. If they have already issued the shares, you'll write investment account debit to equity share capital like that. In most of these problems, shares would have not got issued. Hence, we will use SBPR. Okay. Again, check the question, what words they've used and accordingly pass. If they don't mention anything, credit SBPR itself. Okay. This is one thing. Okay. Next, other way. We can look at the other way also. Service received by H. Service is received by H. Maybe it's a holding company. Holding company ka employees. Okay, but shares is given by subsidiary company. Subsidiary company is giving shares to holding employee. Rare but possible. Okay. So who's receiving service? H Limited. So whichever entity is receiving service, they will credit employment benefit expenditure. But who is issuing shares? S. Whoever is issuing the shares. Have they already issued shares? No, they are planning to issue shares. Whichever entity is planning to issue shares, they will credit SBPR. So S will credit SBPR. What should S debit? Because S is giving shares and giving to HK employees and getting nothing in return. That means now S will treat it as dividend paid to holding company. Because S is giving some benefit to holding company and not getting anything back and not getting the reimbursement out of it. So S will think that they have given dividend to holding company. So they will pass a journal entry, dividend to SBPR. H also same thing. H receives service. So they will write from their employees. So they will write employment benefit expenditure. But they can't credit SBPR because they are not issuing the shares. Who issuing the shares? Subsidiary company. So subsidiary company will issue the shares. After that, holding company has an obligation to pay subsidiary company. No, that means H will think that they have received a dividend from a subsidiary company. So the journal entry will be employment benefit expenditure account debit to dividend account like that. Okay. So this is a scenario when there is no obligation to reimburse. If there is obligation to reimburse meaning holding company initially will give shares and later recover. So that means what? On one hand, they are giving and other hand, they'll recollect. So in this case, how to do the accounting? So service receiving entity, whichever entity is receiving service, the service, whoever is receiving the service, they will debit employment benefit expenditure account. But can they credit SBPR? No, but because they are not issuing the shares, right? So they can't credit SBPR. Oh, but another company is planning to issue the shares. So we can't credit SBPR. Instead of that, what we'll do? Now other company is issuing the shares. After that, we have to reimburse them. That means we have a liability. So we'll either credit liability, or if you have already reimbursed means credit bank account. Our study material, I think ICA study material question they put bank account, thinking that reimbursement has already happened. If reimbursement has not yet happened means you will create liability account like that. So service receiving entity, they will write employment benefit expenditure. Since they are not issuing the shares, they can't credit SBPR. But other entity has issued, and this entity has an obligation to pay the other entity. So they will create a liability account. If they already paid instead of liability, you will credit bank account. Now when it comes to the share issuing entity, the entity which is planning to issue shares, they will credit SBPR. What will they debit? Right now they've issued the shares, but later on they'll recollect it back. That means if you have already collected, you will debit bank account. If you are yet to collect, you will create one asset account. So asset account if you are yet to receive. If you have already received means bank account debit to SBPR account. If you have already issued the shares, instead of SBPR, you can also credit equity share capital account like that. So do remember this. I think we had 2 or 3 questions like this. It may come for 2 to 3 marks, okay, not more than that. But yeah, but it's a good question, easily can be fitted into the case study as well. Okay. Yeah, I think, 1 second, let me quickly review. Yes, people, I think with this, all the concepts and questions relating to IND AS 102 we have completed. Thank you so much for your patience. I think we'll take about half an hour break and then we will take up the remaining topics. Thank you.